the markets, both domestically and around the world, are now starting to find themselves between a rock and a hard place. You've got accelerating economies, both domestically and abroad. You've got accelerating inflation in some spots. And you have not just the Bank of England, but the Fed and others talking about accelerating the pace of interest rate increases and maybe going more times than we had anticipated. So what we're finding out right now is the degree to which these markets are sensitive to a certain level of rates. Each time we've approached 2.9% on the 10-year Treasury late last week and again today, the market really began to tank. And so I think, as Stephanie said earlier in the program, interest rate sensitivity is extremely important here. It's shaking out all the weak, over-levered hands. The real question we have now, I think, really involves longer-term issues about increasing the size of the deficit, who finances it, how does it get financed, at what cost. So there are a lot of, I think, moving parts on this. This is a little bit more like three-dimensional chess than it's been in a while. And I don't think we're quite out of the woods yet.
But has the move been magnified, Ron, do you think, to some degree because of the unwinding of this volatility trade we've been identifying?
Yeah, I think so. But, and it goes back to, and we've talked about some similarities to 1987 writ small here with portfolio insurance, a strategy that was deployed in the mid-1980s, which we both talked about at the time, where selling begat selling. If the market was going down, you sold futures to cover your losses, which just prompted other people to sell more stock. Here we've got kind of the inverse problem with the same result, where you were buying the dip and selling volatility. Now you have to buy volatility and sell stocks, and that's exacerbating downside action. So it's partly mechanical. Mike Santoli was talking about that earlier in the week. But it is, I think, partly now starting to buck up against fundamental issues around the pace of growth, whether or not inflation accelerates, and whether or not central banks normalize rates faster. And to the extent that the deficit grows and the Fed's not going to be the buyer of bonds, what happens to the cost of servicing U.S. debt? What happens to the size of deficits? And how does that impact not just the markets, but the economy going forward? And I think markets are beginning to grapple with that a little bit.
Before you step in, Mike, just point out, if you hadn't heard, they're still talking in Washington right now about a budget bill that the CBO has just scored in the last hour, which showed a much larger increase in the deficit if it were to pass. But it's still a big question whether this thing passes tonight or not.
Without a doubt. And it's certainly invading the psychology of the market, this idea that here we are at full employment and we're still going to be looking at trillion-dollar deficits. On the other hand, at least today, or at least this week, Ron, the bond market is not in any kind of similar state of deep concern about this, at least apparently. Yes, sure, the yields are at their highs in the longer end, but it's not as if they're spiraling. And I wonder, the scenario you set up there, if we're really going to be kind of trapped in this squeeze between what central banks might do and despite a good economy, stocks struggling, it means that we're going to believe that central banks are, in a sense, forced to go in this direction, that they won't really have discretion because inflation will not allow it. That all remains to be seen at this point. I mean, we're really kind of jumping ahead a few spots.
Well, and that's what markets do, right? I mean, they typically jump ahead at least one, if not a couple of spots. But I think at least psychologically, people are beginning to look at this and say, hey, if the Fed is not only raising rates, but reducing the size of its balance sheet at a time when deficits starting either this year or next may top $1 trillion annually. Remember, tax reform is going to cost about $140 billion annually. This new budget, if it passes, is going to be $360 billion over 2 years on top of the existing deficit. That pushes you over $1 trillion. You don't, unless the Fed decides to monetize that debt and continue to buy bonds, which is in and of itself is inflationary. You then have no big natural buyer of bonds. We're about to enter potentially a trade war with China. Will they continue to buy bonds? We got open questions as who the natural buyers of bonds will be as the deficit gets larger. And that's a place you shouldn't be at this point in the cycle. Quite the contrary, we should be running surpluses by now after 9 years of expansion, not accelerating the size of the deficit.